All right, let's do this. It's time for a deep dive into the U.S. real estate market as of March 2025. And we've got, well, let's just say a stack of reports to get through.
A stack is putting it mildly. We've got LinAR, Zillow, CoreLogic, CBRE.
Even some whispers from those government folks.
Always got to have those insider insights, right?
Absolutely. But let's set the stage for our listeners. We're not in that wild, wild west of 2021 and 2022 anymore.
Right. No more bidding wars, 20 offers over asking.
Thank goodness. But it's not a crash either. It's not all doom and gloom headlines.
It's more like finding its footing, I'd say, both for residential and commercial real estate.
Yeah. So is 2025 the year the market finds its new normal? Well, let's find out.
The data tells a very different story depending on which part of the market you're looking at. Residential is definitely giving off those gradual recovery vibes.
Okay.
But commercial is, well, it's a mixed bag. Some sectors are actually doing surprisingly well, which we'll get to later.
That's super interesting. Let's start unpacking all of this, starting with residential. Everyone's saying things are cooling down from that pandemic frenzy, but home prices are still up.
Definitely. And our reports actually show that the national median existing home price hit $396,900 in January 2025,
Which is,
a 4.8% jump year over year. So that's 2 solid years of price gains.
wow. Right.
But here's the thing. While every region did see those increases, the Northeast is sort of bucking the slowdown trend. They're at plus 9.5% year over year. That makes you wonder what's going on up there, right?
Yeah.
Meanwhile, some parts of the Mountain West, that market was red hot, remember?
Oh, yeah.
Well, they're actually below their peak values.
Right.
Hawaii is even down 4.4% year over year. So very different stories depending on where you look.
Location, 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 right. But usually when prices are higher, people rush to sell. What's happening with inventory this time around?
That's the thing. There's more inventory out there, but it's still really tight.
Yeah.
We're talking about 1.18 million existing homes on the market in January, which is roughly 3.5 months of supply.
Oh, wow.
And we need, remember, 5 to 6 months of supply to be considered balanced. And here's another interesting data point. Homeowner vacancy rates are near record lows. People just aren't moving.
Well, it makes sense, right? Why sell if you've got that sweet low mortgage rate you locked in a couple of years ago?
Exactly.
But for those who do need to buy, what are they facing with mortgage rates? Because those have been a huge factor, right?
Yeah. They're really the big story here. As of mid-March, the average 30-year fixed rate is hovering around 6.7%, down a bit from those late 2024 peaks, but still,
Still high.
yeah, about double what it was back in 2021.
Ouch.
Yeah. Imagine buying your first house now versus back then. It's a totally different ballgame.
All right, so let's break this down. We have high rates. We still have pretty high prices.
Right.
This has to be impacting affordability, right?
Oh, in a big way. I mean, we're talking about one of the least affordable housing markets in decades. And here's chief economist Lawrence Yun. He didn't really mince words. He straight up said, housing affordability remains a major challenge.
Yeah, I saw that quote.
First-time buyers are really getting hit the hardest. Their share of purchases dropped to just 28% in January, which is one of the lowest numbers on record.
They're basically getting priced out.
Yeah, it's tough out there for those first-time buyers, for sure. So it's really interesting, you see these trends and you see how they're playing out in the different segments of the market.
All right, so given all of that, let's talk about buyer demand. How is all of this affecting sales? Is the market, dead?
Not dead.
Okay.
I would say just more discerning. The frenzy is definitely over.
Right.
But the interesting thing is there's still a lot of potential out there. Millennials are aging into those prime home buying years, and the job market's decent. So they're out there, they're just being pickier, which makes sense. Right?
Yeah, absolutely. So existing home sales are still happening, just not at the same crazy pace we saw during the peak.
Exactly. January saw about 4.08 million existing home sales, which is actually up slightly year over year.
Okay.
So it's not a buyer's free-for-all. Homes that are priced well, they're in desirable locations.
Right.
They're still seeing multiple offers.
So it's almost like a standoff.
Yeah, a little bit.
Interesting. Okay, so what about new construction? Are builders rushing in to try to fill the gap, especially with this huge supply shortage?
They're trying. Single-family housing starts did rebound in late 2024 after a dip, and we ended the year around 1.55 million units started.
Okay.
But then we had those January blizzards and,
Right.
everything slowed down again. Single-family starts are now down to a 1.37 million annual pace. So
So it seems like they want to build, but something's holding them back.
Yeah. I mean, you'd think with that multi-million unit supply gap we have in the U.S., it'd be a huge incentive to build, right?
Absolutely.
But it all comes down to costs, labor costs, material costs, and even those new tariffs that everyone's been talking about. It's really eating into their profits.
Yeah. It's expensive to build a house these days.
Oh, yeah. Definitely not cheap.
All right, let's shift gears a bit and talk about renters. Are they seeing any kind of relief?
Well, the data from Zillow shows that asking rents were up 3.5% year over year in January.
Okay.
So it's more in line with historical averages, but it's still an increase. The good news is that rent growth is slowing down.
Okay.
Some of those hot markets like Austin and Phoenix even saw some slight declines in late 2024, and that's probably due to all those new apartments finally coming online.
So classic supply and demand. But 3.5% is still a pretty substantial increase for, people trying to make ends meet.
For sure.
So are there enough rentals out there?
That's the thing. The vacancy rate is still pretty low. It was 6.9% in Q4 of 2024, which is barely changed from a year earlier. So it's slightly better for renters, but
Okay.
compared to, say, the mid-2000s, it's still very competitive.
Yeah. Imagine trying to find an apartment back then.
Oh, I remember those days.
Yeah.
Not fun.
So it sounds like landlords still have a little bit of an upper hand then.
Yeah, for the time being.
So slow and steady improvement, but no dramatic shifts. Would you say that's the theme for 2025?
For residential, I think that's a pretty fair assessment.
Mm-hmm.
But things get a lot more interesting when we look at the commercial real estate side.
Ooh.
Yeah, that's where we're seeing some really big surprises and some challenges that are forcing the whole sector to adapt.
All right, I'm ready. Let's dive into that. Where should we start?
Well, let's talk about the elephant in the room, the
Yeah.
office sector. It's kind of having an identity crisis in this post-pandemic world. Nationally, 19 to 20% of office space is empty. Empty.
Wow.
And in those major coastal markets, like, think San Francisco, Houston,
Right.
some of them are topping 30% vacancy rates.
30%. That's a lot of empty desks.
Yeah, it is.
So what's going on there? Is it just those remote work trends?
Remote and hybrid work are definitely huge factors. Companies are just realizing they don't need as much space. And it's a slow and sometimes painful adjustment for that whole office sector. But there is a glimmer of hope, though. Late 2024 actually saw the first positive net absorption, meaning the amount of occupied space increased rather than shrank in 3 years.
Mhm.
And leasing activity is starting to pick up, too.
Okay, I'm intrigued.
But there's a catch.
All right. I figured there was a catch. What is it?
It's mainly for those high-quality buildings.
Okay.
Companies are downsizing, but they're moving into their best spaces and leaving those older buildings behind. It's like they're trying to create those amazing office experiences to entice people back in.
So basically two different office markets now.
Kinda, yeah. You've got
Yeah.
those premium spaces versus, well, the rest.
Interesting. Okay. But if companies are pushing for more in-office time, won't that eventually help the whole sector?
That's the million-dollar question, right?
Yeah.
I mean, demand is slowly recovering, but office vacancy will probably stay pretty high for a while. And that's because the way we work has fundamentally changed. Remote and hybrid work are here to stay. We're just going to have to, rethink what the office of the future actually looks like.
That's fascinating.
Yeah, it's a really interesting time for that whole sector.
Okay. So let's move on to retail. I mean, everyone's been saying it's dying because of e-commerce, but what did our deep dive uncover?
Retail is the quiet achiever, It's holding steady even with those high-profile store closures we've all seen. Nationwide, the retail availability rate was just 4.7% in Q4 2024,
Wow.
which is basically near historic lows.
So even with e-commerce, those physical stores are still in demand.
It really comes down to limited new development, high construction costs, cautious lenders.
Right.
It means fewer new retail projects are happening.
Okay.
So even with moderate demand, vacancies have shrunk, and that gives landlords the power to raise rents. Asking rents nationwide are up about 2.5% year over year.
So retail's not dead, it's just evolving.
Exactly. What kinds of retail are doing well?
Think service-oriented businesses, things like restaurants and gyms,
Right.
discount stores, things that people actually do. They don't just buy products there. They actually go and do something.
Yeah.
It's about experiences and convenience. That's where retail is finding its strength.
Makes sense. Okay, so reports of retail's death have been greatly exaggerated.
Definitely. It's a survivor.
Okay, let's talk industrial real estate. Those warehouses must be booming with all the online shopping these days.
It's definitely strong,
Okay.
but it's coming off of its peak. Leasing activity hit almost a record in 2024. 838.6 million square feet.
Wow.
But net absorption was the lowest since 2010.
Okay, wait, so companies aren't necessarily needing more space?
Right. They're more focused on upgrading.
Upgrading, so it's not just about e-commerce.
Exactly.
Right.
Think bigger, fancier warehouses. Companies are moving from those old, smaller facilities to those mega hubs with, all the bells and whistles.
Oh. It's all about efficiency and automation these days. And all that moving around actually pushed the vacancy rate up to about 6% by the end of 2024.
So they're kind of playing musical chairs.
In a way, yeah.
So what's driving this shift?
A couple things. We had a record amount of new warehouse space built in 2024, like 408.5 million square feet. Developers really went all out, and after years of those double-digit rent growth, things have plateaued, even dipped in some areas. The competition is heating up.
So every sector has its own story unfolding, it seems. What about multifamily? Are those buildings actually helping with the rental crisis everyone's talking about?
Occupancy rates did stay pretty high, around 95%, and vacancy is still healthy at about 6.5 to 7%. But remember all those new apartments we talked about?
Yeah.
Well, they finally hit the market last year, and that really cooled rent growth significantly. I mean, we're talking basically flat rent growth in 2024 after those wild spikes of 2021.
Okay. So that's good news for renters.
Absolutely.
But what about the investors who poured money into these new buildings?
Well, the market absorbed those new units surprisingly well. We saw more concessions offered than big rent cuts, which kind of shows that there's still that underlying demand there.
Right. It's a balancing act, but it seems to be working so far.
Yeah, it's like there's always that domino effect.
Definitely.
One sector influences another.
For sure.
Before we get into those forecasts and predictions, what's the overall picture for real estate investment in general? Because those capital markets can make or break the whole thing, right?
They really can. And things definitely slowed down in early 2024 thanks to those high interest rates.
Right.
But there were some signs of life by the end of the year. Q4 2024 saw investment volume jump 31% year over year. So it's like everyone held their breath.
Right.
And then decided to jump back in.
Okay, so what changed their minds? Did people just get used to the higher rates? I think sellers got a lot more realistic about pricing, for one thing. Those super inflated valuations just weren't sustainable. Plus, those financing conditions got a bit better. Not like a flood of easy money, but enough to get those deals moving again. And private investors, so think high net worth individuals, 131 exchange buyers, they were the most active in the market. Institutions and REITs were more focused on those industrial and multifamily sectors like we were talking about, and even foreign investment ticked up.
So a cautious return, but return nonetheless.
Yeah, I think that's a good way to put it.
What about cap rates? Because that can make or break a deal for an investor, right?
Absolutely. They rose in 2023, but they seem to have stabilized. And for prime properties, they've even compressed slightly. It's like investors are kind of like, okay, the dust has settled, let's get back to business.
Yeah.
Except for office, that's still a bit of a different story.
So some sectors are back in favor, but office is still lagging behind.
It's a tough one because with office, you're seeing those distressed sales, which means big discounts, but it's still kind of a risky bet. The whole sector needs like a reimagining, and that just takes time.
So every sector has its own set of challenges and opportunities. With all this data, though, it's tough to see the forest for the trees.
Right.
What's the overall picture for construction and development? Are the cranes still dotting the skyline, or have things slowed down?
Let's just say those cranes are being a lot more selective these days. Higher financing costs and construction expenses have kind of put the brakes on development. Office development has practically stopped.
Yeah.
Industrial and multifamily are trending down, although multifamily still has a huge pipeline to complete.
Right.
And retail construction, it's still very limited.
So developers are being cautious.
Yeah, I would say so.
So what are they building?
They're focusing on the essentials. So industrial facilities that are really tied into those supply chains that everyone's concerned about, multifamily residential in areas with actual housing shortages, and then those specialized properties that serve those niche markets. But speculative office towers and big retail projects,
Right.
not so much.
It's like the market's taking a breath,
Right, yeah.
reassessing, focusing on what really matters.
Exactly. Back to basics.
But the U.S. is huge. Are there any big regional trends that are standing out in all of this?
Absolutely. The regional differences this year are fascinating. Some areas are completely defying the national trends, while others are really feeling those shifts more strongly.
Well, let's break it down then, region by region. See what those local stories are revealing. Maybe you can get some insight into where the market might be heading next.
Sounds good to me.
Ready for part 2 of our deep dive.
Ready when you are. All right, so we're jumping into those regional trends that we were just talking about. Remember, real estate is all about location, and this year is no different. We're seeing some really unexpected winners and some areas that are still adjusting to that new normal.
Okay, well, let's start with a region that's been surprisingly strong, the Northeast. Their home prices are up 9 to 10% year over year, the fastest in the nation. What's going on up there? Didn't they get the memo about the market cooling down?
Right. They're definitely bucking the trend, that's for sure. Inventory is so tight up there, especially New England and upstate New York, all those charming towns with the good schools. It seems like those factors are really outweighing those higher taxes and that, shall we say, brisk weather.
So a classic case is supply and demand driving up those prices. But what about those big northeastern cities? Are they back in the game after the pandemic? Everyone's talking about New York's comeback.
Yeah, New York City IS back with a vengeance. Rents and condo prices have rebounded so strongly. Manhattan's apartment rents hit record highs in 2023, and they're still elevated. It's really a testament to the city's resilience, that enduring appeal of the Big Apple lifestyle.
Yeah, it seems like people are craving that urban energy again. But what about those other northeastern hubs, like Boston and Philadelphia? Are they keeping pace with New York?
They're seeing solid growth, but it's definitely more moderate. It's more in line with the national average. Boston is benefiting from its eds and meds sector. Those universities and hospitals, they're really economic engines drawing people in. And Philadelphia, well, it's got that affordability factor working for it, especially compared to New York.
So the Northeast is a bit of a mixed bag, but overall a region with strong fundamentals and a lot to offer, even with the market shifting the way it is. But what about the Midwest? They've always had that reputation for stability and affordability. Are they living up to that reputation?
The Midwest is that steady eddy of real estate signs. Home prices are up 7.2% year over year, which is a bit above the national average. But that's still nothing compared to those double-digit jumps we were seeing in other areas.
So no wild swings, just that steady growth.
Yeah.
What markets are standing out in the Midwest?
It's those rising star cities like Columbus, Indianapolis, Kansas City, Minneapolis. They've got those strong job markets, a good mix of industries, and of course, much cheaper homes than those coastal areas. So many people are moving there. It's really no wonder they're attracting all those new residents and businesses.
So the Midwest is like the best-kept secret of real estate, offering that opportunity and affordability. But even with that steady market, are they feeling the inventory squeeze?
They're not immune, but they're definitely doing better than some other regions. Their inventory is tighter than normal, but there are more options there than in, say, the Northeast or the West Coast.
So buyers in the Midwest might actually have a little more breathing room, less of those crazy bidding wars we keep hearing about.
Potentially, yeah. It's not a buyer's market by any means, but it's a little more balanced than those super competitive areas.
Well, that's good news for those Midwestern buyers. Speaking of hot markets, we can't forget about the South. The Sun Belt's been leading the nation in growth, attracting retirees, remote workers, everyone. But are they still riding that wave? Or is that Southern charm starting to fade a little bit?
The South is still a powerhouse, but things are definitely shifting, that's for sure. It's a huge region. You've got both the Southeast and Southwest, and each state, each city even, has its own unique story.
So it's not all sunshine and sweet tea down there anymore.
Well, there's still plenty of sunshine, but the market is definitely maturing. You know those Sunbelt superstars, the ones that saw massive price surges during the pandemic? They're experiencing a bit of a reality check.
Reality check. What does that look like? Are prices actually dropping in some of those once booming cities?
Some of them, yeah. We saw it in parts of Florida, those popular coastal communities like Fort Myers and Sarasota. They got so overheated that they just had to adjust. Austin, Texas, remember that was like the pandemic, darling? Well, they saw prices dip before stabilizing. And even Phoenix, that desert metropolis, it's cooled down quite a bit from those double-digit growth days.
So those markets are feeling the effects of those higher rates, the affordability concerns.
Definitely, it's all playing a role.
Maybe a bit of boomtown fatigue.
Maybe a little bit of that too, yeah. But here's the thing. The South is so vast and diverse that while some of those formerly red-hot markets are cooling down, other areas are still seeing solid growth. Texas in general is still a huge force. Dallas-Fort Worth and Houston, those economic powerhouses, they're still attracting tons of new residents and businesses. And those vibrant cities in the Carolinas like Charlotte and Raleigh, they're still drawing people in with job opportunities and that appeal of urban and suburban living, all in one place.
It sounds like the South is going through like a recalibration.
Yeah.
Some areas cooling down while others are picking up the slack.
Exactly. It's all about those local nuances and those shifting market trends.
So the South is still that dynamic region full of opportunity. But it's all about understanding those local markets and really paying attention to what's happening on the ground. All right, so we've covered the Northeast, the Midwest, and the South. That leaves us with the final frontier in our regional deep dive, the West Coast. It's been a roller coaster ride out west with those huge price surges and those notable pullbacks. Where do things stand now? Is the West Coast still the land of real estate dreams?
It's a fascinating region for sure. California especially has been making headlines with those housing market ups and downs. What's the latest from the Golden State? Are those sky-high prices finally coming down to earth?
Well, I'm curious about that too. I mean, the San Francisco Bay Area was once the epicenter of the tech boom and those crazy prices. What's happening there now?
The Bay Area actually saw one of the sharpest corrections in the whole country. Prices plunged like 10 to 15% from their peak in 2021.
Wow. What happened? Did the tech giants just pack up and leave?
It was kind of a perfect storm. You had the tech layoffs, remote work allowing people to move further away, and a general feeling that those Bay Area prices just weren't sustainable anymore. It led to a lot of people leaving, and that really cooled down that once red-hot market.
So is San Francisco still struggling? Or are things turning around? I keep hearing whispers about a resurgence.
This is where things get interesting. San Francisco home prices are actually starting to rise again. They seem to have hit bottom, and now that notoriously low inventory is pushing those prices back up, it's a good reminder that real estate is cyclical. Those markets often rebound, especially the ones with strong fundamentals.
So those bargain hunters might have missed their chance to get a steal in San Francisco.
Maybe so, yeah. But remember, California is a huge state with all these different markets. What about Southern California? Los Angeles, San Diego. Are they experiencing that same rebound as San Francisco?
I'm curious about that too. Those are such iconic cities.
Southern California is recovering, but at a slower pace. Their price dips weren't as dramatic as San Francisco's, and they're now back to more moderate single-digit price increases. It's a steadier, more sustainable kind of growth, which might be appealing to those who don't like all that volatility.
So stability over boom and bust.
Exactly. It's a much more mature market.
Well, that makes sense. But what about those other West Coast magnets? Seattle and Portland. They also saw those pandemic price surges. Are they holding on to those gains or are they feeling the pinch?
Seattle and Portland also had those price corrections, but Seattle's actually starting to inch back up again, driven by, you guessed it, low inventory. That lack of available homes is a common theme in so many of these markets, and it just creates that upward pressure on prices.
It really is the story of the decade in real estate. Okay, last but not least, those Mountain West boom towns, all those places that everyone was flocking to during the pandemic, Boise, Salt Lake City, Phoenix, Denver, they were experiencing such incredible growth.
Yeah.
Are they still those hot destinations?
The Mountain West is another area that's going through a little bit of an adjustment. Those boom towns are definitely seeing a slowdown, a return to more sustainable growth.
So from boom to bust.
I wouldn't say bust, but definitely a shift in momentum. Boise and Phoenix have leveled off after those declines. Las Vegas has cooled down, and even Salt Lake City, which was holding onto its gains pretty well, is starting to see its growth taper off.
So those markets are feeling those higher rates, the affordability concerns.
Definitely. And, maybe even a little boomtown fatigue.
Makes sense.
Yeah,
But even within the Mountain West, are there still some bright spots?
absolutely. Even in those areas experiencing a slowdown, there are always those micro markets bucking the trend. Montana, parts of the Rockies, and certain areas of Utah are still seeing a lot of demand. People want those open spaces, that second home market, and of course you've got those remote workers looking for a change of pace. It's all happening.
So even within a region, there are those micro markets that are telling a different story. It seems like the more we zoom in, the more nuanced this picture becomes.
It's all about those local dynamics, really understanding what's happening on the ground.
Absolutely. Okay, so we've zoomed in on all the regions. Now, let's zoom back out and ask that big question. What's the overall market forecast for the rest of 2025? Are we headed for a crash, a boom, or something in between?
The consensus seems to be a gradual recovery. No one's predicting a dramatic crash or another unsustainable boom. It's all about finding that new equilibrium.
So a more stable, predictable market, less excitement maybe, but also a bit less anxiety.
Exactly. But there are always those outside forces that can influence things, right? Those interest rates are still a big question mark, and the overall health of the economy will have a huge impact.
Of course. Let's dive into those forecasts sector by sector and see what those experts are predicting.
Let's do it.
Okay, so we've talked about prices, inventory, all those regional trends,
Yeah.
even those global economic forces that are swirling around out there. But now for the part I'm always excited about, those expert insights. What are the pros saying about this new normal in real estate? What should our listeners be thinking about as they make their own decisions in 2025?
The phrase I keep hearing over and over again is back to basics. Remember those pandemic extremes with the crazy bidding wars and all cash offers?
Oh, yeah.
Those wild price swings? Well, those days seem to be gone. It's a more grounded, rational market now, which honestly might be a relief for a lot of people.
Yeah, like a return to sanity. So what does this back to basics approach mean for buyers, sellers, and investors?
Well, for sellers, it means being realistic about pricing. Those inflated expectations from a year or two ago, they've got to let those go. Buyers might actually have a bit more negotiating power now, but they also need to really factor in those higher interest rates when they're making those decisions. And for investors, well, they're being more selective. They're focusing on that long-term value, looking for properties with those solid fundamentals that we've been talking about.
So no more chasing those quick flips or those like speculative bets.
It's about making those strategic, well-informed decisions. One really interesting comparison I've heard is to the late 1990s.
Okay.
Remember that period of slow but steady housing growth?
Yeah.
That's what a lot of experts are predicting for the next few years. No bubble, no crash, just those consistent, sustainable gains.
Speaking of experts, we have to talk about NAR's chief economist, Lawrence Yun. He's been pretty optimistic about the housing market's recovery. What's he saying about the rest of 2025?
Yoon is actually really bullish on 2025, especially when it comes to that inventory situation.
Yeah.
He's been saying that the worst of that shortage is finally over.
Okay.
More homes are being built, and some of those hesitant sellers might finally be ready to list their properties.
So more options for buyers.
Yeah.
Maybe a little less competition.
Exactly. As that supply increases, buyers will have more choices. And that should lead to a more balanced market. Yoon is even predicting a 7 to 12% rebound in home sales this year.
That's pretty huge if it happens.
Uh,
What about those higher mortgage rates, though?
well, Yoon actually expects mortgage rates to fall a bit, maybe around 6% by the end of the year, which would definitely be a boost for affordability.
Fingers crossed. Okay, but what about commercial real estate investors? What are the experts at CBRE saying about where to put your money in 2025?
CBRE is also watching those interest rates really closely. They're saying that cap rates, which we know have been on the rise, will likely peak and start to improve by late 2024, early 2025.
Okay, so quick explainer for our listeners. Cap rates are basically a way to measure that potential return on a commercial property investment.
Right.
A higher cap rate usually means a higher risk, but also a higher reward. So what CBRE is saying is that as those interest rates stabilize, those cap rates should become a bit more favorable for investors.
Exactly. It's a sign that the market is stabilizing, and those investors who were maybe sitting on the sidelines might be ready to jump back in.
So a cautiously optimistic outlook for commercial real estate.
It's all about being strategic. Understanding those market nuances. We talked about office and how it's facing some headwinds, retail's holding steady, and industrial and multifamily are still those hot sectors attracting a lot of interest.
So no matter what sector you're interested in, whether you're buying, selling, or investing, it sounds like 2025 is shaping up to be a year of
Gradual recovery, no crazy booms, no dramatic busts, just a more steady, predictable market.
Yeah, I like that.
It's really all about adapting to those new realities, making smart choices and maybe even embracing a little bit of that back to basics mentality.
I love that. Back to basics. So to wrap up this deep dive into the U.S. real estate market, remember 2025 is all about staying informed, understanding those local trends, and making decisions that align with your own goals. Whether you're looking for that dream home, selling your property, or building that investment portfolio, there are definitely opportunities out there.
And remember, real estate is a long game. Don't get too caught up in those short-term fluctuations. Do your research, talk to the experts, and stay focused on those long-term goals.
Excellent advice. Thanks for joining us on this deep dive. We'll be back soon with more insights to help you navigate this crazy world of real estate.
Until next time.